Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have back with me again this week David Jensen. He's taken a couple of weeks vacation with his family, and so he's refreshed and raring to go. Welcome, David. Good to have you back.
Good morning, Jay.
Really missed not talking to you for a couple of weeks because we like to keep up with your latest statistics on what's going on in the physical markets for precious metals as opposed to the paper markets. And if anything, the disparity from what you're telling me this morning, David, is it's grown since we last spoke. Talk to us a little bit about these metals that we follow so much. I mean, most notably, the disparity is in platinum and, well, palladium most of all, and then platinum as well. Talk to us about the physical price, the price for physical delivery of palladium and platinum, as opposed to the forward price as quoted in New York and London.
Sure, Jay. I think in context, just taking a quick look at GOFO in terms of the London gold forward rate, it's very settled. It's 0.065%. It's basically the cost of borrowing gold and lending gold is the same as of dealing in U.S. dollars. But as you note, palladium has really shown itself to be in shortage now if we look at the disparity between the price for physical versus the price for these partially backed paper contracts that are trading in London and New York. So this morning, just quickly checking the numbers, the price on the Shanghai Metal Exchange for palladium is running about $1,033. Which is about $168 premium over the price in New York and London, which is about $865.
Wow!
And that's a $30 drop in New York and London from the day before. So yesterday there was a $30 drop, and a part of that was recognized in Shanghai, but there's now the premium has increased to $168 or 19.4%. Mm-hmm. And when we started checking these numbers daily at the beginning of July, that was about $120. And the other one that's really interesting in terms of a standout for me is silver. Silver is trading at about $1.52 an ounce premium on the Shanghai Gold Exchange. And recall on the Shanghai Gold Exchange that to write a contract, you have to deposit a bar first. Mm-hmm. So this reflects actual trading of physical metal, and the $1.52 premium that we're seeing in Shanghai is about a 7.8% premium over the New York and London what I call the paper prices. Mm-hmm. So we saw that on July 1st. There's about a 2.5% premium on silver, and that has grown steadily since to now that it's in the 8% range, and it looks like it's getting ready to climb even higher. So those are the real standouts. Platinum remains elevated. It was 5% at the beginning of July in terms of a premium, and that has now grown to about a 9.3% premium, or $129 an ounce. So it's a continuing trend. These are the metals that we expect to be in deficit this year, platinum, palladium, and silver in particular, and they are indeed showing the highest price premia in Shanghai, and these prices are climbing. And it looks like there is now a very clear separation that is increasing between London and New York derivatives or digital metal trading and the actual trading for the physical metal on markets where you're actually buying and selling metal itself.
Mm-hmm. Interesting. I think in talking to you before we went on the air, you mentioned that there's something like a 24% deficit expected for palladium this year.
Yeah, Standard Bank has come out with an estimate that there's about a 2 million ounce deficit expected now through the end of the year on palladium. And that's of a market that's where the total demand is about 8.5 million ounces. Mm-hmm. So you're looking at 23.5%, and these are all just estimates. But we know that the Russians, who had been supplying in previous years about 2 million ounces into the market, that they've basically reversed that and have started buying in the market in 2013, the Russians, Norilsk said the Russians had only supplied about 100,000 ounces. But now they've gone from a few years ago where they were supplying 2 million ounces, year over year, to now stepping in and actively buying in the market. So there is going to be a tremendous shortage, and I would expect these price premium to really start accelerating for the physical metal. And I would think that the difference between New York and London, where you can essentially have unlimited metal available because they're not trading the metal, they're trading quote unquote labels or metal positions, if you want to call it that. In New York, where they're trading positions, to where they're actually trading the metal itself in Shanghai. So the other note too is doing some research over the last few days, to see the tremendous disparity between London's trading and the rest of the world's actual trading of metals. It's about 85% of the global gross daily trading volume is on the LBMA. So that's supposed to be a physical exchange, and they're not trading physical anymore. They're trading extraordinarily highly leveraged instruments, and they're calling it metal. But there's been a really subtle change in the market since the late 80s as this paper has become more and more of a dominant driver there in London.
Well, now, David, if I'm the treasurer at North American Palladium or Stillwater Mining, or if I'm a shareholder of those companies, and I'm hearing what you're saying here, there's 19.4% premium if I deliver the metal to Shanghai. Now, it might cost me a little bit more to get it there, but not that much more. And so I would think that sooner or later, these paper markets there's simply not going to be any metal delivered to them at all. Now, that may be fine for people that want to just play the Wall Street casino game up to a point, but to the extent that people who enter contracts to buy palladium on New York and London markets are not able to receive it, it seems to me there could be a real pinch, a real dramatic rise, or let's say a real fear trade that could take place as a result of this, a panic, if you will.
Yeah, I think that's what's going to happen in the end, is that there's going to be a realization that the markets are drying up at least, and there's going to be a move to secure the actual asset itself.
So I would think that if I'm a treasurer at one of these companies, at Stillwater Mining, that I'm wanting to sell my platinum, or my palladium, I should say, for 1,033 rather than 865, and that I would expect that's going to happen, isn't it? I mean, if it's not, I'm a shareholder. I mean, he has a responsibility to his shareholders to get the best price he can for his product.
Yeah, what you have, though, are industry standard benchmarks, and it takes a bit of time to change the psychology and to accept other benchmarks. But certainly, and I've dealt with these contracts myself, and typically you reflect that the price will be on a certain day. It's going to be the LBMA PM fix, or the LPPM in this market, the London Platinum and Palladium market, which is the benchmark for the Palladium and Platinum players. But certainly, there should be adaptation with time, that they should sell to the market where they can get the highest price, and I think that's what's going to happen. But looking at overall, that we've got these trading volumes, like every day in London, they're trading 1.6 billion ounces of silver, and we know that the global above ground refined stockpiles of silver, including all the exchange traded funds, the ETFs, is about 1.4 billion ounces.
That's amazing.
Right. So if you have, so what's the notional open interest out there? It's over 3 billion ounces. And so you've got 3 billion ounces of trading positions where people think they're sitting in physical, quote unquote. There's 1.4 billion ounces in all the other warehouses around the world. You've got 1.4 billion, and there's going to be a reckoning between this the paper market comfort and the reality that the metal isn't there, and that's going to happen. With time. It happens slowly, but I think with exponential growth of knowledge and understanding, which typically happens over time, that you will have a rush and a squeeze in the end for people to actually secure the metal itself, as they realize, that London and New York are really trading numbers, and that if you want metal, you've got to go somewhere else.
David, do you know if there's any degree of forward selling for financing through, that is, let's say, palladium sales forward to gain financing, project financing, as happens in the gold market? And if that's the case, then it would be the same bullion banks probably involved in those markets, in the New York and London market, that would demand or would structure their contracts so that the metal is sold in London and New York as opposed to Shanghai.
Yeah, I can't comment on that. I don't have
You don't
specific
know.
knowledge,
Yeah.
but
Uh-huh.
I do note that if you read Stillwater's quarterlies or North American Palladium's quarterlies, that their price realized is increasing quarter over quarter. So I don't think that they have forward sold. I can't comment on the large South African miners, which I do not follow closely
Yeah.
as
Okay.
an investor because of the insecurity of the assets.
Okay, fair enough. Well, you talked about silver also, and that's a 7.8% premium. But I notice also, though, that even gold has a small premium, and you and I have talked about this before. Gold is a much deeper market. There's a lot. It's a much so there's more liquidity there, and but even so, there is a 0.3% premium according to the information you sent me earlier today in gold, and this is highly unusual too, isn't it?
Yeah, to some extent, I think that to give a sense of the other metals versus gold, I mean, the above ground stockpiles are roughly equivalent to annual production from mines, or some fraction thereof. Platinum and palladium, they're running around 50% to 100% of annual mine production is the estimated above ground stockpiles. But with gold, you've got annual mine production is only about 1.5% to 2% of above ground gold. So that the other metals are more or less consumed and they're used up. And so there isn't this massive overhang in the market of the other metals themselves in terms of refined metal that's available to market. With gold, there's multiples of the of annual mine production that's sitting above ground. So you would expect that to be a more liquid market, and you would expect the tightness of the physical demand to be less because of that large overhang in the market, especially in the hands of the regulators, which is the central banks, ultimately coordinated by the Bank for International Settlement, which is the central bank of central banks.
Just one more point before we conclude our discussion today. The new Shanghai Free Trade Zone gold market goes live on September 26th. Talk to our listeners about the significance of that.
Yeah, that is on the Shanghai Gold Exchange right now. It's only for domestic purchases and sales. With the new free trade zone gold market that's opening up, that allows foreigners to buy and sell gold with renminbi or yuan in China, and I think that what that will do is really increase or contribute to the acceptance of the yuan as an international trade medium, because there's the understanding that you can secure something that is for it in volume that has real value. And so September 26th, you can take your yuan into the new free trade zone and exchange it for gold bullion, and I think that will really contribute to the acceptance internationally of the yuan for trading.
Do you see this possibly being another piece or component of the BRICS strategy to find an alternative to the dollar?
Yeah, ultimately it will fit in there, but it is, from my view of things, it's definitely a contribution towards China getting a stance in the international market. So, the BRICS move as a group, but they also move individually, and so there's interests of each individual country there. I noticed that Russia has talked about settling oil trades in rubles as well. So they're not all moving in one direction, but I think that in the end, that as it becomes more and more clear which is the currency or multiple currencies accepted the most freely that the trade will move towards exchange in those currencies themselves.
Because they have something real behind them. They're not just name currencies.
Yes, it's the reason that the U.S. dollar was accepted, now for 100 years as a international trade medium, because it was good as gold initially, until the default occurred in the 70s there with Nixon, closing the capacity to exchange dollars for gold.
Yeah, and I suspect, David, that still in the minds of many, many Americans, they don't even realize that there's nothing behind the dollar because, and I say that a number of years ago, well, it's probably 10, 12 years ago, when my son was in junior high school, and he came home and told us that the history teacher told him that the dollar was still backed by gold. So
Yeah.
in the minds of people, the dollar is backed by gold, when in fact, of course, it couldn't be the case because the dollar is losing so much of its purchasing power over so many years. Just one more note I notice here. The LBMA silver price is replaced the daily silver fix. I guess that's now taken place, has it?
Yes, it has. It happened last week.
Yeah. So, in other words, there's no good old boys fix anymore, or we have a true free market, or
yeah. No,
let's hope.
It's the same old new boss, same as the old boss type of thing in terms of the silver market, and the daily London silver price that we're going to be getting now. It's an algorithm. It's a computer program that matches and selects what the price is. And if you want to actually observe the process of the fixing in terms of the price movements, you've got to have a Reuters terminal. And of course, Reuters and the CME, the Chicago Mercantile Exchange, are the two groups who are responsible for the new London silver price. So, there's no visibility there. Gold Court did a really excellent job in highlighting the problems with this. It was an opaque process for the selection of it. Mm-hmm. There was a ban on release of information of the decision-making process through the use of what is called the Chatham House rules, where you're not allowed to freely and openly discuss exactly what goes on. The presentations from the CME Reuters group, specifying why they should be selected over the other bidding parties, hasn't been released.
Stinks.
It's the same old. It's an opaque process, and really the fix itself is not so much the issue. It's how can you trade 1.6 billion ounces of silver every day when you don't have it in your warehouses and your trading instruments aren't backed by anywhere near that amount of metal. It's wash trading, Jay, as you and I talked about. You've got the clearing members. They're trading 10 times more volume than the net daily settled volume. So the gross trading volume is 10 times higher than the posted volume there that they give on the LBMA website every day. And that gives you an idea of the amount of it which is real. It's just going back and forth between these clearing members. It creates such enormous volume and a noise in the market that you can't really see what the true pricing level of these metals is.
Yeah, well, if you believe as I do that ultimately you can't fool Mother Nature forever, and it seems to me with these rising premia, as you just pointed out, it is suggesting Pinocchio's nose is getting longer and longer, and sooner or later I think the confidence issue that convinces people that a fraudulent dollar is as good as gold will be recognized to be a falsehood, and ultimately I think the markets will correct, and that day of reckoning is likely to be very, very unpleasant, especially for people who aren't prepared for that day. So that's what we try to do on this show, at least, is to help people be aware of real market forces and the truth in many different areas of the world we live in, including geopolitics, which we just talked to Daniel McAdams of the Ron Paul Institute for Peace and Prosperity about. Well, I want to thank you again, David. Anything else you might want to add today before we conclude our discussion this week?
Just a note that the analog to me of watching this activity in the market over the last few months here is it reminds me of like a great blue marlin on a fishing line. And with the rate of seeing the change, it's just enormous in terms of the premia that are being generated in Shanghai, and the relentless climb, and especially the climb of silver from about a 2% premium up into the 8% range now. Given the background that we know that there's deficits in these markets in terms of the supply to the markets, I think that this is going to really, really move now, and this can't continue much longer in terms of the structure of the market, given what we're seeing, because this dryness in the market of the physical metal itself is going to cause a increasing difference between the paper markets and the physical markets. And at some point, there's going to be a break point where people realize that there are two prices in the world for things.
Mm-hmm. And they're no longer going to send their physical metals to the London, New York exchanges and send them where they'll get real value for the metals that they're producing. And so hard won from the earth. It's clearly one of the problems that the mining sector has had is an artificially low and suppressed price for the precious metals, which I believe is by design. And certainly we talked to Chris Powell recently on the show about Gibson's paradox and the need to suppress the gold price, especially the need to suppress it when you're suppressing when you have financial repression and the reduction of interest rates. So the only way to keep people from flooding out of the dollar into gold is to fix the price, and I think that's what they're doing through this massive paper game, David. And I want to thank you again for sharing your insights and helping us understand what's going on. It's very, very important for our listeners. Thank you.
Thanks very much, Jay.